This is our Forex blog for October 26, 2012. And like we do most days, we use our currency meter as the first step of our three-step Forex trading system to find which currencies are strong and which ones are weak. You can see the ones that are extremely strong when they hit or above the dotted 80 level. This means that with all the different statistical tools that we're using to measure this, that not only is the real-time trend up, but more than likely most of the daily, weekly, monthly trend is up as well, or it can never really get to that plus 80 or minus 80 level. So this is what the new currency meter looks like. The older one, traders would tell me, especially new traders, that it was confusing because we had the real-time trend on the top. Underneath that we had the 15-minute trend, hourly, daily, weekly, monthly. Now obviously this is still available if you want to use it. When all the time frames line up, it's a no-brainer. You can see the CAD's down on almost all time frames. The New Zealand's up on all time frames. But some days, the real-time trend could be up. The 15 and hourly trend could be up. The daily trend could still be down. The weekly trend could be down. The monthly trend's up. And traders would tell me they didn't exactly know how to trade those type of markets. So basically, this makes it simple because you can see the CAD is extremely weak today. The New Zealand's strong for most of the day. The pound's strong. The yen is also strong today. So let's start with trading the CAD yen. You want to sell the weak CAD versus a strong yen. So as you look at this chart, you can see a bunch of sell signals, and sometimes the market only pulls back 8 or 10 pips. This one pulled back 10 pips, 5 pips. This one here, this sell signal here nailed a 10, 20, 30, 40 pip drop. And you can see that this one worked, this one worked, this one here failed, this one worked. So the majority of our signals, work very well. We've been working on these for months and improving them every day. So the first step of our easy three-step system is to use the currency meter and focus on trading the ones that are most likely to continue to trend and most likely to give you much bigger pip wins, when you're right, than you're going to lose if you're wrong. Because we use range charts, typically 5 pips per bar, we put a pip padding on the other end of that plus the spread. You're going to lose less than 10 pips when you're wrong, and most of the time 6 to 8 pips are max. And when the market starts to move your way, you tighten your stop in half, you tighten it to break even. So a lot of trades don't even have a loss or have very small 3 or 4 pip loss. And as you saw from that CAD yen, even this trade here might have made 5 pips, break even, 30 pips, 5 pips, 20 pips, 8, 9 pip loss, 30 pips, and so forth. And so that's the real key to our methodology. Now again, the pound was very strong. We don't typically leave the pound CAD running, but I will bring it up. And let's see when the pound was strong. It was strong really around 4, and it had mild strength, not any of the kind of extreme strength that some of the other pairs had, like the yen earlier. But you can see that this one pretty much worked its way up. You look to buy pullbacks, and I would classify a pullback as anything that moves back 15 to 25 pips. So that trade here counts as a pullback. This one probably counts as a pullback. So you can see a nice trade here. This one, if you got long here, it went up. Buy this pullback here, it went up. Buy this pullback here, it went up. There's really 2 methods that we use for trading. One is a pullback trade, the other one's a little sideways rectangle trade. A lot of times you get these sideways rectangle trades after a pullback as well. So you would go long right here with your stop underneath here. Anytime it goes your way, then comes back down against you. When it starts to go back up again, you're moving your stop up underneath that bar's low. And you never know where it's going to go. Always draw your fibs just to get an idea of where the market could stall at. And if it can't get past those fib areas, get out. So at least you make 10, 15 pips versus having it result in a loss. Earlier in the day, the dollar and yen were both strong. The CAD was weak, so you can buy the dollar CAD as well. I just hit the minus key to zoom out on this one to make them line up at the same time. The Swiss and the Euro tend to coincide with each other. You can see just astronomical weakness here around 5:30 in the euro. At 5:30, between the dollar and the yen, you can see there started to be some strength here in the yen, whereas there wasn't at that particular time in the dollar. So looking to sell the euro yen is a good trade. Let's bring that one up. So here is the euro yen, and the first thing to look at, if you just want to take a currency and trade it itself, look at the hourly moving average. If price is underneath that, you want to sell. Is it underneath the previous day's point of control, the most actively traded price yesterday? That's the yellow line right here. The orange line is the most actively traded price last week, and obviously anytime a currency breaks from above to below that level, it's very likely to continue to trend down. So some of the trades our signals didn't pick up that I would personally have taken is this one right here. This trade right here is false, but usually when you get a counter trend, or I'm sorry, a trend trade that fails, when it goes slightly higher and can't break out, this is a perfect example of our rectangle pattern right here. And so when the market statistical momentum runs out of steam right there and breaks down, it's very high probability. And you have another one of those right here near the lows. Now this is a little bit higher risk trade because typically under the white 2.0 band, the market kind of runs out of steam. And when it's this weak, remember right around 6:30, this was one of the currencies that would have been on your watch list. Draw your fibs off that last wave and get an idea of where the fib target is. Get short. You're risking, in this case, about 10 pips to make about 15. And this one actually went farther than where our first Fibonacci profit target was. It went down another 15 pips. So you made 30 pips on this trade while risking 10. If you shorted right here, you made about 10. If you shorted here, you probably lost 5 or 6. Lost, made a little bit, made a little bit. Shorted up here, made a little bit, lost, made 30 pips. You can trade these signals, and anytime they line up with fib retracement levels, which you'll have to draw yourself from the high all the way down to the low, you can see that if you take the trades that are underneath the the green 3.0 band, relatively risky trade. Once you get up to the 38% to 50% retracement level, these trades start to be higher probability. This one here is lower probability. It's very hard to teach a computer to know where the fib targets are correctly drawn. So, discretionarily take the trades that pull back a decent amount to the 38% or 50% fib level. Short here, short here, short here, short here, short here, and maybe even short here. You wouldn't have taken this or this and avoided these two losses, avoided this loss. You would have avoided this trade here, which would have been a win. You would have avoided this trade here, which would have also been a loss. And that will improve your odds of trading using these tools. Now, these FX trade signals are improving each day. One of the rules I'm going to actually put in there right now is to avoid trades underneath the 3.0 green band because it's down statistically too far. So I got to put extra rules in these two signals right here, and they're not going to show up on the chart in the future. Also, our counter trend trades, the higher the probability, the bigger the circle is, and I will paint them green or red. And those are higher probability than the gray ones. The gray ones are potentially low probability reversal trades. They don't stand out on the chart as much, but they're less likely to have you get into trade. Now, if you see a sell signal and then a counter trend sell signal right near each other, they cumulatively add to the probability. You have two counter trend signals right here, and you can see a nice little bounce afterwards.